thank you for joining me today. I have some groundbreaking news for you. Okay, well, at least to me, it's groundbreaking, and I really want to hear from you what you think about this. It has to do with the price of gold and silver and the precious metal mining stocks. But what it really has to do with is the P word, the pivot word from the Fed. We know that when the Fed pivots from being hawkish to being dovish, that's going to send the price of precious metals through the roof and the mining stocks. But here's this key concept, and I want to run this by you. I want to see your thoughts on this, but it makes perfect sense to me. There's a lot of comparison going on recently to the 70s when we had super high inflation, kind of like we have right now, and how Paul Volcker came in and raised rates to 15% and killed inflation and blah, blah, blah. Well, I was thinking last night, and again, I want to hear your thoughts on this. I was thinking last night, back then, debt levels were like this high, right? The national debt was like, I think 25 or 30% of GDP. Corporate debt was much lower. Mortgage debt was much lower. Consumer credit debt was much lower. There just was not as much debt, right? So he could blast those rates higher and had to really kind of slam the brakes on the economy and put a, nip inflation in the bud. Now, fast forward to today, we have super high government debt, right? 130% of GDP. Corporate debt's through the roof. Mortgage debt is through the roof. Consumer credit debt is absolutely through the roof. Much higher levels of debt way up here, right? If this was, let's just say in the 70s, 30, now we're at 100, right? Just for numbers' sakes. If you think about it, could a smaller rate increase now, because the debt levels are so high, have a much more impact, have a bigger effect, right, on the economy? Because there's all this debt, all this consumer debt, all this mortgage debt, that it's going to take a smaller increase in rates to create the same desired effect that they were able to do or had to do back in the 70s and 80s when they had to raise rates much, much higher, because back then the debt levels were lower. Let's use the analogy or example of a family to show how this would work. A 1979 family with $20,000 in debt. Rates go up by 10%, which they did. That would be about $2,000 additional a year in interest expense. That would curtail that family's ability to spend by about $2,000. Now, let's look at a family today with $200,000 in debt. If rates go up by just 1%, that curtails their ability to spend by the same $2,000. It took a 10% increase in interest rates on the $20,000 to have the same effect as a 1% increase in interest rates on the $200,000. The whole point of this is, has the Fed already gotten to a point where they've achieved their desired effects? Now, I know inflation is still running hot, but in terms of slamming the brakes on the economy, it sure feels like it, right? Housing sales are down, retail sales are down. All the economic indicators are showing us that this small move by the Fed, because the debt levels were so high, has really slowed things down. And now the Fed doesn't want the economy to go into a deep recession or a depression, so they're going to have to pivot soon. They're going to have to start being a little more dovish. And when that happens, gold and silver will skyrocket. So will the precious metal mining stocks. We'll be here to enjoy it. Let me know your thoughts. I want to hear what you think about this. And until next time, be well.